So let us very first of all understand and differentiate between YTM, forward rate or spot rate, and forward rate. So the first primary point of difference between YTM and spot forward, whom I would want to keep in a single category, same category, YTM and spot forward, if I have to differentiate between the two, the primary point of difference is that. Do you agree interest rate is used for the purpose of borrowing and lending? Everyone, any kind of interest rate. What is the primary use of interest rate? If I borrow from you, with interest I will have to pay to you. If I lend it to you, with interest I will receive. Correct? So can I say on my timeline, can I say if this is the amount of borrowing or if it is the amount of lending, can I say it is my present value? To this amount, whether borrowing or lending or present value, if I add interest, I get the amount of future value, which means I get the amount to be repaid against the borrowing or against the lending, how much amount is needed to be repaid. The use of interest rate, what is the use of an interest rate? To calculate the amount of repayment, in other words, to calculate the future value, right? So spot rate and interest rate, spot rate and forward rate are the types of interest rate in which there is no intermediate cash flows. Listen to my line, I will explain it later. Listen it first. Spot rate and forward rate do not have, or spot rate or forward rate can be applied to only those situations in which there is no intermediate cash flows. Whereas YTM can be applied even to those situations where cash flows have intermediate cash flows as well. For example, for example, if I borrow here a sum of rupee 100, right? Suppose on this rupee 100 interest is needed to be paid. One way to pay the interest is that if the rate of interest is 10%, one way is that you pay me 10 rupees over here, right? And rest of rupees 110 over here, which means first year's interest is paid in first year, second year's interest is paid in second year, which means in second year there will be interest of 10 plus the original principal of rupee 100, right? But do you realize in this kind of borrowing, I don't have the cash flows only at the start and only at the end. I also have intermediate cash flows. I also have intermediate cash flows. So if you have intermediate cash flows, right, the discounting of those cash flows can be done only at the rate of YTM, right? You cannot discount those cash flows at the rate of spot rate or forward rate. Spot forward not applicable to this situation. If you go to market, you ask the bank, sir, what is the bank, what is the spot rate? Bank tells you it is 10%. You know what does it mean? It means that 100 rupees you borrow today for a period of 2 years, and if the spot rate is 10%, the bank is expecting you to pay the entire amount at the end of second year. So you do on your calculator 100 plus 10%, first year's interest plus 10% plus 10%, which means that is inclusive of the compounding effect. 121 rupees is to be paid at the end, which means a spot rate does not include any kind of intermediate cash flows. Even the forward rate does not include. Are you people requesting your responses able to understand the difference between spot rate and YTM? People, so first of all, you have to identify that particular rate gives you what kind of cash flows. Because when you borrow at the rate of spot rate, you have to realize that to the bank, you will have to pay the entire amount only at the end of the maturity, no cash flows to occur in between. Or in other words, if the cash flow is already there, everyone in the class, if the cash flow is already there and you need to discount that cash flow using a particular rate, please listen to me, you want to discount a particular cash flow using a rate, so you have to identify that if YTM is 10%, if a spot rate is 11%, if the cash flows if the cash flows also have intermediate cash flows, you cannot discount it using spot rate, all the cash flow using a single rate. of 2 years. For example, this is a 3-year rate. 3-year spot rate is 11%, right? The cash flows are also three cash flows. You cannot discount all three cash flows, everyone, using 11% of spot rate, because a spot rate does not include 1 and 2 years intermediate cash flow, only third year cash flow. But can I discount it using 3-year bonds YTM? Yes, because bonds YTM, which is also a kind of interest rate, automatically considers intermediate cash flows. So first point of difference that a student must realize is this. Are you people understanding? And if you realize, you should not be shocked to know that when we were doing the valuation of the bond, please recollect, when we were doing the valuation of the bond, if my YTM used to be 10%, suppose a bond is for 3 years, 3-year YTM in the market is 10%, right? Do you people realize not only the cash flow of third year was being discounted using this rate, even the cash flow of 1 and 2 year can also be discounted using the same rate. All the cash flows falling till maturity can be discounted using that YTM is the quality of YTM. Agreed? That is how we had done the valuation, right? Go back and find out any question of valuation and you will realize a single rate was being used to discount all the cash flows. Every time we calculated present value annuity factor, what did that mean? Annuity factor itself mean all the cash flows in that series are being discounted to find out annuity factor, present value, right? Now, if you know the difference between this category, spot and forward, which does not include intermediate cash flows, we can now try to differentiate between these two. Suppose you go to bank, you ask bank that I want to borrow. So bank says that, see, at whatever point you borrow, there will not be any intermediate cash flows. You will have to make the payment only at the end. We said, fine. We know the difference between YTM and these two. Fine. So I go to the bank and bank says that, okay, when do you want to borrow? I said today, right? Bank says for how long? Is it for 2 year, 3 year, or how many years? I said, how does it matter? Bank says it matters. Because different maturity has different rate of interest applicable. If you want to borrow today for a year, that has a different rate. If you want to borrow today for 3 years, that has a different rate. Borrow today for 4 years has a different rate. Are you finding it logical to have different rates for different maturity, everyone? Do you think it makes sense? What do you say? People, what do you say? Because the rate of return the bank would want to earn, please apply the common sense here, the rate of return the bank would want to earn would depend on the risk which is involved. If I borrow from bank for a period of 1 year, it is less risk. Because bank knows my situation today, it knows the situation of economy today, and bank knows that the situation won't change significantly. But if I borrow the bank for a period of 10 years, where I have to pay the entire amount after 10 years, the bank does not know what will happen to me after 10 years. What will happen to the economy or the industry after 10 years? Can you feel the bank has a higher element of risk? Or an element of higher risk in case of 10 years, right? Dhananjay, it is not time value of money. I'm not saying, please understand, no. Thank you so much, Dhananjay, for putting this up. When I said rate of interest for 1 year is 5% and 4 year is 6%, boss, both are per annum only, needless to mention, everyone. If it is 6%, every year you have to pay 6, right? Every year you have to pay only 5. Why? Because of higher risk involved. Correct. So which is fine. One thing we got a clarity is that, sir, if I want to borrow today, listen to my line now very carefully, giving you, an official kind of explanation for spot rate, right? The rate applicable to any borrowing that starts today for 1 year, 2 year, whatever number of year is called a spot rate, as you can observe in the green with the arrows with the green color, that all the arrows are starting from today. Which means, do you agree 5.5 is applicable for a borrowing which starts today and which ends at the end of third year? 6 is applicable for a borrowing that start today which ends at the end of 6th year. Which means if you go to bank and you want to borrow for 3 months, 3 years, can you borrow at the rate of 5.2%? No. Can you borrow at the rate of 6%? The bank is fine, but you won't agree to it because you have an option to borrow at 5.5. Correct? So next thing to realize is that for a particular time period, you have a particular rate that applies to that time period. Simply, I want to say this. Correct? Cool. Again, you go to the bank, you stand here at 0 point. You go to the bank and ask the bank, sir, I want to make the borrowing. The bank says that borrow today at this point. Today, these are the interest rate, right? But you say that no, I want to borrow after a year, not today. So bank says that come after a year. Why are you coming to me now? If you want to borrow after a year, come then. No, why are you coming now? Because we say to the bank that bank, we are afraid that the interest rate in the market may change. As we have already discussed in our class, and I'm happy to give that example of Russia-Ukraine war in our class, which significantly affected the interest rates, right? So you have now seen how can interest rates change significantly, and now I feel, now you know that, sir, when I stand today, we are telling to the bank that bank, today it is fine, it is all fine, but I'm afraid what will happen to the interest rates after a year. Because after a year, when I will stand here and when I will come to you and ask you to borrow, you may say that the repo rate by RBI has been increased to control the inflation, or because of global whatever set of things, the interest rates have spiked. Now at that point, when I borrow at the rate of 8%, it is a significant loss to me. Are you people understanding the problem? It is only when you understand the problem, the solution will make sense to you. Requesting your responses, please, everyone. Do you realize the problem I'm facing when I go to the bank to borrow after a year? So bank says that, okay. Obviously, when you need the money after a year, absolutely there is no point to borrow it today, because what is the point of paying extra interest for that 1 year for which you don't even need the money? So bank says that, okay, we have a solution. When you stand today, let us enter into a contract. Let us enter into a contract in which we will agree, both of us will agree, in which I will, as a customer, I will say that I will borrow, bank will say, okay, the bank will lend. And today we agree to a future rate. We have entered into an agreement where I said, bank, you borrow me, I will borrow from you an amount after a year for a year, after a year for 2 years, or after a year for 3 years, for example. Similarly, I will borrow after 2 years for a year, after 2 years for 2 years. I stand at 0 point, and I'm talking about the borrowing starting from a future date. And for that period, the rate that is applicable is called as forward rate, applicable to a forward period, right? Which means today, if I ask the bank that what is the rate after a year for a year, bank will say 5.4%. Which means today, if you enter into this agreement with the bank, you don't have to worry about tomorrow what may turns out to be the interest, even if in the economy tomorrow it turns out to be 8. Tomorrow, which means on that day when I stand, do you agree, on that day when I stand, if the interest rate turns out to be 8, it doesn't matter to me, because I already have an agreement to borrow at 5.4 with the bank. People in the class, are you able to connect to my thoughts? Requesting your responses. I need everyone a validation on this. Yes. And you know what? Can anyone in this world except the God can estimate or can guess what will be the spot rate tomorrow? Acha, first of all, before I say this line again, you have to understand, sir, tomorrow when I stand here, the rate from this period to this period, can I say on that day it will be called a spot rate? On that day it will be called a spot rate, because spot rate means the rate that is applicable for a borrowing that starts today. So on that day it will become today, right? And that rate will be spot rate. But what that spot rate will be in the market, no one except the God can has an ability to predict. It is uncertain, it is future. Am I making sense? Requesting your responses, people. And since you don't know what will be the spot rate on that day, you stand today and make an agreement to borrow for that future date. And when you stand today, it becomes a future to you, and hence the rate is called as forward rate. Requesting your responses, people in the class. How settled are you to understand the concept of spot rate and forward rate? I'm yet to speak on this, but till this point, everyone. So do you realize even for a forward rate, different maturities will have different rate. You borrow after 1 year for 1 year, different rate. After 1 year for 2 years, different rate. Please understand, every time I say rate, it is obviously per annum. When it is 5.4 and it is 5.5, don't assume that for 2 year it is 5.5. For 2 year, it is 5.5% per annum. Every year you have to pay 5.5. But do you realize the nature of both the kinds of interest rate is that there is no intermediate cash flows? Means if you borrow 100 rupees here at the rate of 6%, at the end of first year, if you borrow 100, it will mean that at the end of fourth year, you will have to pay 100 plus 6% plus 6% plus 6% with compounding effect, all the everything at the end of fourth year. Correct? So now I think I will be explaining the most important line to you. The most important line, which means the line based on which all the practical questions would get solved. Do you agree? Do you agree that every rate has a specific period for which it can be used? For example, this particular rate I want to use of 6%, this particular rate, I can use it only for a time period for a borrowing between 1 to 3. Neither it can be used from 1 to 2 or 2 to 4 or 1 to 4 or 1 to 3. Nothing, nothing, nothing. The only time period for which this rate can be used is from 1 to 3. You want to borrow at 1, you want to repay at 3, you can use this rate. Correct? Only and only. Which means, do you realize every interest rate belongs to a particular period? The most important line, which means if you want to use any rate to do PV or FV, if you want to use any rate for the purpose of discounting a cash flow or compounding a cash flow, you have to realize that for the purpose of that discounting or compounding, use only that rate which belongs to that particular period. Which means, imagine I have a cash flow at the end of fourth year. Imagine I have a cash flow at the end of third year, at the end of fourth year, which is to be discounted back to 2 years. Or I have a cash flow at the end of second year, which is to be discounted back to 4 years, which is to be compounded to 4 years, right? No other rate, no other rate which is applicable to the time period 2 to 4 can be used. For example, rate for this is 6%. For the purpose of compounding and discounting both, only 6% rate can be used, not 5, not this, not this. No other rate can be used to compound or discount to the cash flows which is applicable for that time period. Requesting your response if you understand this line. I think you will understand all the concepts of valuation coming ahead. People please, people please. Everyone. Quick, what do you say? Could I explain that to you? So through this discussion, in conclusion, what all you were supposed to understand, let me tell you. One, what is the difference between YTM and spot forward? Right? When I borrow at the end of first year, is there any cash flow lying in the second and third year? No, there is a cash flow only at the end of fourth year. First difference between spot forward in one side and YTM at the other. Whereas if you realize the case of YTM that we've already done, if a bond has a life of 5 year, YTM also discounts the cash flows falling in 1 to 3 and 4 year. That difference is clear. Second difference, borrowing that starts, rate applicable to a borrowings which starts today's spot rate, rate applicable to a borrowing that starts on a future date is forward rate. Third thing, which means if any cash flow, third thing, any cash, the rate which can be used to discount a particular cash flow or compound a particular cash flow, should be only that rate which is applicable to that time period, right? Or in other words, any cash flow, if you want to compound or discount, any cash flow, if you want to compound or discount, only that particular rate can be used to compound discount that cash flow which is applicable to that time period. In whatever words you want to understand, the concept is all clear to you. And last, you know what? You need to now know certain terminologies. Acha, so what I just explained has been written over here. You may proceed to read this line. People, any given spot or forward rate can be used to compound or discount the cash flows, which is compound the cash flows from PV to FV or discount the cash flows from FV to PV, the cash flows only for that time period to which the rate applies. And therefore intermediate cash flows cannot be discounted using these rates. Clear? Fine. Now you all need to get yourself comfortable with certain terminologies. This presentation, people in the class, this presentation, everyone, which has the rates of interest, whether spot or forward, applicable to different time periods. This presentation can either be in the form of graph as it is here. It can either be in the form of table, rate applicable for 1 year is this, 2 year is this, 3 year is this. This presentation of interest rates is called as term structure of interest rates or yield curve. Term structure of interest rate or yield curve. Why do I need to share these terminologies with you? Because people in the class, you have to understand that institute may use these words in the question, and you should be able to process that. Okay, when they say this line, what does it mean? It means that they are giving the schedule of interest rate applicable to different time periods. First thing. Second, I have explained to you the concept of spot rate and forward rate, right? Even that is done. The last and the most important, which is going to be the test of your intelligence, everyone. All the students in the class need to think on what I say, right? Spot rate of interest. Spot rate of interest are these rates, are also called as zero rates, or zero coupon bond rates. Zero rates or zero coupon bond rates. If anyone in the class has an ability to think, why is that? Please tell me. So I am again planning to upload even this video on the YouTube people. If you think you know the reason behind it, you need to tell that to me right now in the comment section. Live people, recorded people, apply your brains to figure out why do you think it is called as zero rate, zero coupon bond rates. Quite easy actually, or no? Come on everyone. Sir, if you imagine a zero coupon bond rate, Sahil, that was thought really well. If you imagine a zero coupon bond rate, I would 100% agree to the fact that zero coupon bond means there is no coupon in between, which means if you imagine the cash flow of a zero coupon bond, there is one cash flow at the start, which means when you pay the issue price, and there is another cash flow at the end, which is the redemption value, which is equals to the face value, and no cash flow to take place in between. So if you people realize, let me link the two things, and now your mind will be blown out. Everyone, I think so. If you imagine the YTM of a zero coupon bond, can I say YTM is the rate of interest again applicable to these cash flows? YTM of a bond, what is the YTM of the bond? Let me take you back to find out the YTM of a bond. So for a zero coupon bond, how did we calculate this YTM, this applicable rate, the rate of return, the rate of interest? Sir, CMP, which is the present value, cash flow today. Redemption value, which is the future value, cash flow of that day. And relationship between this cash flow is the rate, which is YTM. Correct? So YTM is the amount of return made in for a zero coupon bond in this case, right? For that time period. And if you guys realize, since there is no coupon, can we say it is same as a spot rate, because even the spot rate says the return, the rate of interest applicable to this when there are no intermediate cash flows. First thing, only this much we are able to think so far. Sahil, this is appreciable. Every live recorded YouTube student who could think of this appreciable. I need to go a step ahead of this. People, you tell me one thing, sir, even the forward rate, if you realize, has no intermediate cash flows. So why only spot rate are called as zero coupon bond rate? Because everyone in the class, you have to realize that a bond existed today. A bond will not exist in future. Do you have any bond which will start to exist in future? No. If the bond exists today, it has a YTM, and hence I will have to say it can be related only to the spot rate that starts with today. Correct? Hence, if you realize how does market find out spot rate? People, this is the ultimate clarity of thought, and this I think has never been spoken to any batch. How would market get to know what is the spot rate in the market? The market will calculate YTM of a zero coupon bond. The market will go to the prices of a zero coupon bond, find out to calculate the YTM, and market knows for different maturity of zero coupon bond, whatever is the YTM is the spot rate. Market will say, look at the 1 year zero coupon bond, 2 year zero coupon bond. 1 second. Market will say, look at 1 year zero coupon bond, 2 year zero coupon bond, 3 year and 4 year. And all of them anyways have no intermediate cash flows. So YTM of that zero coupon bond is nothing but the spot rate. That is how spot rate in the market are being determined. And if you think, sir, how are then spot rates determined? You will learn it mostly in today's lecture itself. Everyone, this was, I think, my best of explaining what is spot rate, forward rate, everything with respect to these two things, including the difference with YTM.